Pakistan's official GDP in 2024 was 346 billion. That makes it 41st largest economy in the world, a lower middle income country, perpetually dependent on IMF bailout, unable to fund its own development. But here is the problem: the informal economy alone. The bazaars, the workshops, the unregistered businesses, the daily wage labor is estimated at $457 billion. This is bigger than entire merged economy. So Pakistan's government is making trillion rupees policy decisions, negotiating IMF conditions, setting tax targets, planning infrastructure, all based on a number that may be capturing less than half of what is actually happening in the economy. Today, I want to show you exactly why the Pakistan's GDP is undermined, how large the gap actually is, and most importantly, what it means for policy. There are three specific measurement gaps. Let's go through them one by one. Why does this gap exist and why does it matter? These are not rhetorical questions. They have specific technical answers, and understanding those answers changes how you read every economic headline in Pakistan. Official GDP is 346 billion US dollar, 41st largest economy in the world, but informal economy alone is 457 billion US dollar. That is from SMIDA and ILO joint study done in 2024. Every major policy decision like IMF conditionality, tax targets, infrastructure spending is calibrated to this official number. Measurement failure have real governance consequences. The three gaps are: first, informal economy problem. A massive share of Pakistan's economic activity is simply invisible to the national accounts. Second, the base year and methodology problem. Pakistan is measuring our 2024 economy with our 2015 ruler. Third, the PPP are the purchasing power parity and remittances blind spot. The way we compare Pakistan's economy to the world systematically understates its real purchasing weight. Each gap individually is significant. Together, they mean that the official figure is not just incomplete, it is structurally misleading. Let me start with what we actually know. In 2024, a joint study by SMIDA, the Small and Medium Enterprise Development Authority, and the International Labour Organization estimated Pakistan's informal economy at 457 billion US dollar. The formal economy that same year was 346 billion US dollar. Read that again. The informal economy is 64% larger than the formal one. A more conservative estimate from the Ministry of Finance puts the informal sector's contribution at over 40% of the GDP. A recent study by IPRI, the Islamabad Policy Research Institute, Using the Pakistan Labour Force Survey and Economic Survey data estimates it as 59% of GDP. So the range across the methodologies run from 34 to nearly 60% depending on what you count and how you count it. Now, why does this happen? Why is so much economic activity invisible? The answer is structural. Pakistan has 5.24 million SMEs. The vast majority are unregistered. They don't file tax returns. They don't appear in the business registries. They are not captured in national accounts. Walk through any city in Pakistan, whether it is Lahore's Shah Alam Market, Karachi's Jodia Bazaar, Faisalabad Textile Cluster, billions of the rupees change hands daily. None of it shows up in official GDP. Three numbers tell the story. 457 billion in informal economy size, 72% of non-agricultural employment is informal, and IPRI estimates it at 59% of GDP. The mechanism is simple. Three things are missing. No registration. Millions of SMEs operate without business registration. No tax records, no FBR filing, no formal accounts, and no national account entry. PBS cannot capture what it cannot observe. This is not a Pakistan peculiarity. Even developing economy faces this challenge, but Pakistan's scale is exceptional. The result: Pakistan's national accounts systematically exclude economic activity worth an estimated 40% to 59% of GDP. This is a structural gap, not an oversight. The sector breakdown is revealing. Wholesale and retail trade accounts for 45% of informal sector employment. Then comes the manufacturing, construction, transport, and repair services. These are not the marginal activities. They are the backbone of how Pakistan actually functions economically. 72% of non-agricultural workforce is informal. 5.24 million SMEs, the vast majority unregistered. These are the people doing real work, producing real value, and never enters the national accounts. And this shows up dramatically in one number. Pakistan's tax to GDP ratio is 10.2%. That is the second lowest in the Asia Pacific region, according to an OECD commissioned study, only above Laos. The reason is not simply tax evasion, though that is the part of it. The deeper reason is that most of the economy is invisible to the tax system. You cannot tax what you cannot measure. Compared to the India at 18%, Vietnam at 19%, Thailand at 17%. Pakistan is not underperforming because its people don't pay taxes. It is underperforming because its measurement system excludes most of its economy from the tax base entirely. The informal economy is also carrying an unfair burden. Registered businesses face full regulatory compliance cost, full taxation, full documentation requirements, while competing against informal businesses that carry none of those costs. Formalization is punished and informality is rewarded. The second problem is less visible but equally important. Every country calculates GDP by measuring the value of the goods and services produced using prices from a fixed reference point called the base year. Pakistan's current base year is 2015 to 16, that is fiscal year 2016. That was 9 years ago. In 9 years, Pakistan economy has changed dramatically. New sectors have emerged: digital services, e-commerce, mobile banking, solar energy. Pakistan now has over 190 million mobile users and a fast-growing fintech ecosystem. None of this is properly reflected in a 9-year-old price structure. 3 consequences: new sectors are missed, structural shifts are invisible, and GDP is officially compressed. What does the base year actually determine? It sets the relative price weights across sectors. It determines which industries count as new versus established. It defines the GDP growth rate in constant price terms, and it shapes how Pakistan compares to international benchmarks. Pakistan has rebased its GDP twice in recent decades, from 2000 to 26, then 26 to 2016. Each time the economy grew simply because the measurement improved. The current base year is now 9 years old. The Pakistan Bureau of Statistics National Accounts Committee has acknowledged the need to rebase, but it has not yet happened. To understand what this means in practice, look at what happened when Pakistan rebased its economy in 2013, shifting the base from 2000 to 26. Overnight, the economy grew by 557 billion rupees. The agricultural sector share jumped from 20.3% to 23% of the GDP. Nothing actually happened in real economy. The measurement improved and substantially billions of rupees appeared. The industry sector shed 308 billion rupees in apparent value. Services and agriculture both gained. This is not a real economic change. It is the correction of measurement error that had accumulated over 13 years. The same process is waiting to happen from the current base year. When Pakistan finally rebases from 2016, similar correction will emerge. Agriculture is particularly problematic here. Pakistan's agriculture sector officially contributes 23% to 24% of GDP, employing roughly a 1/3 of the labor force, but the figure significantly undercounts subsistence farming, informal livestock trading, and smallholder production that never enters formal market. Livestock alone accounts for 60.8% of agricultural value addition, but a substantial share of livestock transactions, particularly in rural areas, are barter-based, gift-based, or cash transactions through informal channels that never reach national accounts. The major crops, formal livestock transactions, commercial forestry, marine fisheries shown up in PBS data only. The unmeasured part, subsistence farming, barter-based livestock trade, kitchen gardens, inland smallholder fishing, doesn't. The magnitude of unmeasured portion is by definition unknown. Now, here is what a corrected measurement looks like. World Economics, an independent economic research firm, adjusts Pakistan's GDP for informal economy, the outdated base year, and purchasing power parity. Their adjusted estimate for Pakistan by the end of 2026 is 2.15 trillion US dollar against the official $346 billion nominal figure. That is more than 6 times larger. The adjustment may be aggressive, methodologies differ, but even a conservative correction, accounting only for the documented informal economy estimates, would Pakistan's real economic weight considerably beyond the official figures. The gap between 41st and 26th largest economy globally is not trivial rounding difference. It is a fundamentally different picture of Pakistan's place in the world economy. The third gap is about how we compare Pakistan's economy to the rest of the world. When we say Pakistan's GDP is 346 billion US dollar, we are using nominal GDP, dollar value at the constant exchange rate. But Pakistani rupee buys very different thing than the US dollar. Comparing Pakistan to Germany or United States using nominal GDP is like comparing photos taken with the different cameras at different zoom level. The image look different, but not because the subject is actually different. Nominal GDP measures output. PPP-adjusted GDP measures real productive capacity. A doctor's consultation in Lahore costs roughly what a cup of coffee costs in London. A full meal in Karachi is what a subway ticket costs in New York. Nominal GDP doesn't account for this difference in purchasing power. The purchasing power parity or the PPP corrects this. It asks, what does a dollar actually buy in each economy? The same $5 buys a full restaurant meal in Karachi. In London, it barely covers a coffee. This is not a cultural difference, it is a structural one. And it means that Pakistan's official dollar GDP dramatically understates the real volume of the goods and services its economy produces for its population. PPP correction changes everything. By nominal GDP, Pakistan is the 41st largest economy in the world. By PPP-adjusted GDP, Pakistan is the 26th largest economy in the world. That is a 15 rank difference. It means Pakistan's real economic weight, its actual capacity to produce goods and services for its population, is significantly larger than the nominal figure suggests. The comparison with regional peer is instructive. Bangladesh, Egypt, Vietnam, and on PPP adjusted terms, Pakistan holds its own. On nominal term, it looks like a struggling outlier. Then there is the remittances problem. Pakistan received over 28 billion in remittances in 2024, which is equal to 9.4% of the GDP. For comparison, India's remittances are 3.5% of GDP. Pakistan is one of the most remittance dependent large economies in the world, but the significant portion of these remittances flow through the Hawala system, informal money transfer network that are fast, cheap, and trusted, but entirely outside the formal banking system. Hawala transactions do not show up in the balance of payment data. They do not show up in the household income survey. They do not show up in the GDP. The exact scale of Hawala transfer is by definition difficult to measure. But economists working on Pakistan's financial flow estimate the informal remittances could equal 30% to 50% of the formal remittances volume. At the scale, we could be missing 8 to 14 billion US dollar in actual economic activities from remittances alone. Let me bring the three gaps together. Gap 1, the informal economy. The formal economy is the minority share of 43% of real activity. $457 billion sits outside the national accounts. Gap 2. The base year lag. Outdated weights compress the measurement growth in the fast-moving sectors. When Pakistan rebases, billion will reappear. Gap 3. PPP and the remittances. Pakistan is 15 ranking places higher on PPP terms. 8 to 14 billion US dollar in Hawala remittances is outside the balance of payment. So the combined result that Pakistan's GDP is measured at 346 billion nominals in dollar terms. The economy that actually operates is estimated around 800 billion US dollar to 2.15 trillion depending upon the methodology. You might ask, does this matter in practice? GDP is just a number. It matters enormously because every major economic decision made about the Pakistan is built upon that number. When the IMF negotiates a bailout, it sets conditions based on Pakistan's tax to GDP ratio, debt to GDP ratio, and fiscal deficit as a share of GDP. If the denominator, the GDP, is systematically underestimated, every ratio looks worse than it is. The conditions imposed are calibrated to a smaller economy than actually exists. When Development Bank assesses Pakistan's credit worthiness, they use GDP per capita. Pakistan's nominal GDP per capita is 1,812. At PPP, it is approximately 6,700 US dollar. The investment case for the country at 6,700 per capita is fundamentally different from one at 1,812. When the government sets tax revenue targets, it works from a tax base that excludes 40 to 60% of economic activity. The result is either unrealistic targets or ever increasing burden on already taxed formal sector. And when Pakistan negotiates trade agreements or compares itself to regional peers like Bangladesh, India, Vietnam, it may be comparing a measured portion of its economy against their measured portions. The comparison may not be as unfavorable as it looks. Pakistan's GDP measurement problem, not a technical footnote. It is a governance failure with real consequences. The informal sector is not informal because the people wants to cheat the system. And the former governor of State Bank, Shahid Kardar, and the former Planning Commission Deputy Chairman, Nadeem ul-Haq, have argued informality is Pakistan's response to state that makes formalization too costly, too bureaucratic, and too corrupt to be rational. The base year lag is a technical failure. It is fixable. Pakistan has rebased before in 2006 and in 2013 and the most recently to 2016. The question is whether there is institutional will to do it again. The next video asks the same question about the Pakistan's unemployment number, which is if everything are even more misleading number. The official figure of 7.5 or 7.2%. But when we account for underemployment, disguised agricultural unemployment, and structural exclusion of women from the labor force count, the real picture is dramatically different. Subscribe and I will see you there. Thank you.